here's something nobody actually told you. Saving money can actually make you poorer. Now, before you click off, hear me out. It's not that saving is bad. It's that while your money is just sitting there in that account doing nothing, inflation is running at 2, 3, sometimes even 4% a year. Every single year you wait, your purchasing power drops. The money you save this year buys less next year, and even less the year after that. So you're not building wealth, you're literally just watching it slowly shrink. And yet, every parent, every teacher, every random adult growing up told you the exact same thing. Save more, spend less, be responsible. Nobody, and I mean nobody, ever sat you down and said, okay, but here's what to actually do with it once you've saved it. That gap right there, that's what's keeping a lot of people our age stuck.
I'm Jason, and look, I spend way too much time obsessing over how money actually works for people in their 20s. Investing, wealth building, financial freedom before you're old enough to regret not starting. And today, we're going straight into the complete pathway from saving blindly to investing smart.
Here's exactly what we're covering. Why saving alone is quietly working against you. The step-by-step investing framework built specifically for where you are right now. The 3 traps that kill most young investors before they ever build anything. And the one mindset shift that actually separates people who build wealth young from everyone else. By the end of this, you won't just understand investing differently. You'll think about money differently. Let's get into it. Okay, so let's talk about why saving alone is actually working against you. And I want to be real with you here, because this is way more nuanced than most finance videos make it sound. Maybe you've heard about high-yield savings accounts, HYSAs. Right now, some of them are paying 4, even 4.5% interest. And on the surface, that sounds pretty solid, right? Your money is finally doing something. But here's what nobody's telling you. Those rates are tied directly to the Federal Reserve. The second the Fed starts cutting rates, and they will, your HYSA drops right with it. 4.5 becomes 3, then 2. Then you're losing ground to inflation again. You didn't build anything, you just rented a temporarily good interest rate. And that's the real problem with saving. Not that it's wrong, saving is absolutely necessary. But here's the thing, savings protect your money. They don't grow it. There's a difference, a big difference between your money being safe and your money actually working. And most people never make that switch. Not because they're bad with money, but because taking that first step into investing feels like stepping off solid ground. But here's the thing though, the people who build real wealth in their 20s, they're not smarter than you. They're not taking crazy risks. They just started earlier and they followed a specific process. And honestly, that process is a lot simpler than you think. Here's exactly what it looks like. Step 1. Before you put a single dollar into the market, you need an emergency fund. 3 to 6 months of basic living expenses sitting in a completely separate account. Because look, life doesn't care about your investment strategy. Your car breaks down, a medical bill shows up, you lose a job. If you don't have that cushion, you're pulling money out of your investments at the worst possible time. Usually when the market is already down. Your emergency fund isn't separate from your investment plan. It's what keeps your investment plan alive when real life hits.
Get that built first, then we move. Step 2 is less about money and more about how you think about money. And honestly, this shift alone is worth the entire video. Start thinking about every dollar you have as belonging to one of 2 buckets. Bucket 1, your safety money, your emergency fund, anything you might need in the next year or two. Its only job? Be there when you need it. Bucket 2, your growth money. This is what you invest. And this bucket has one rule. You don't touch it. Not when the market drops, not when you get nervous. You just let it work. Most people don't fail at investing because they picked the wrong stocks. They fail because they invested money they actually needed. They mixed the buckets. Life happened, they panicked, they pulled out. Keep these two completely separate, and you've already solved the biggest mistake most young investors make.
All right, safety net built, buckets separated. Now we actually start putting money to work. And this is where it gets really interesting.
Step 3. Here's something that genuinely surprised me when I first learned it. The amount you start with matters way less than most people think. Like, way less. What actually determines whether someone builds wealth young comes down to one thing. When they made investing non-negotiable. $50 a month into a broad market index fund is not a small move. It's actually the most important move. Because at that stage, you're not really building wealth yet, you're building the habit. You're training your brain to treat investing like a fixed bill, something that comes out automatically before you spend anything else. And that habit, it scales with you. When your income grows, your contributions grow. The discipline stays identical. The number just gets bigger. Set it to auto-invest, let it run. Check in once a year to bump up your contribution and make sure everything still aligns with where you're headed. Consistency beats strategy every single time when you're starting out. And look, here's something worth sitting with for a second. What if you start and the market immediately drops? What if your timing is terrible? Here's the honest answer. It probably will drop at some point. Markets always do. But you're not investing for next month. You're investing for the next 20 years. And in 20 years, the question won't be whether you timed it perfectly. It'll be whether you started. Every single person who started investing in 2005 and stayed in through 2008 was ahead by 2013. Timing feels important. Time in the market is what actually matters. Step 4, and real talk, this is the reason this conversation is specifically worth having in your 20s. Because what I'm about to show you is time sensitive in a way that very few financial advantages actually are. 2 people, same income, same country, same everything. Person A starts putting $200 a month into the market at 22. Person B waits until 32. Same $200 a month, same investments, same average 8% annual return. By 65, person A lands at around $940,000. Person B lands at around $520,000. Same money, same discipline, 1 decade of difference. But here's what makes that gap genuinely insane. Person A contributed around $104,000 of their own money over that time. The rest, over $800,000, came purely from growth. Returns compounding on top of returns, quietly building in the background while person A just lived their life. That gap isn't talent. It isn't income. It's just time. And right now, time is the one advantage you actually have. The question is whether you use it. Okay, now here's the part that actually separates people who build wealth from people who almost build wealth. Because the pathway we just covered works. It genuinely works. But there are 3 traps sitting right in the middle of it that feel completely logical when you're in them. That's what makes them dangerous. Trap 1, lifestyle creep. You get a raise, your income jumps, and almost automatically your lifestyle expands to match the number. None of it feels excessive because you can technically afford it, right? But your investments stayed exactly where they were. So your wealth flatlines while your life looks like it's moving forward. The fix is one rule. Every time your income increases, increase your investments first, before anything else upgrades. Lock that in, then enjoy the rest.
Trap 2, chasing returns. And this one gets smart people specifically because the logic genuinely feels sound. Something is up 300%. Everyone's talking about it. And putting money into a boring index fund suddenly feels like you're leaving money on the table, right? But here's what's actually happening. In most cases, by the time it's everywhere, the early money has already been made. And the people who got in first are quietly getting out. Building your financial future around exceptions is not a strategy. It's a bet. Boring compounds. Excitement gambles. Trap 3, emotional investing. And I want to give you something specific here, instead of just saying don't panic sell. In 2020, the market dropped 34% in 33 days. Fastest crash in American history. People who panic sold in March locked in devastating losses. People who stayed in were fully recovered by August. Same year, 5 months later. The market didn't care about the fear. It never does. Your portfolio going red is information. It is not an instruction.
So, you now have the information, the framework, the numbers, the traps, the mindset. But here's the thing I actually want to leave you with. And honestly, this is more important than anything else we covered today.
The barrier between where most people are financially and where they want to be, it isn't knowledge. It's not intelligence. It's not even income. It's identity. Most people in their 20s think of themselves as someone who will invest someday. Someday when things stabilize. Someday when the timing feels right. And that identity, that someday version of themselves, is quietly the most expensive thing they own. Because here's what actually happens on the other side of starting. You stop feeling like money is something that happens to you, and you start feeling like it's something you're directing. That shift changes everything. Not just your account balance, the way you show up to every financial decision you make from that point forward. Without that low-level anxiety sitting in your chest every time you check your bank account. The person who starts today and the person who waits another year, they're not just separated by 12 months of contributions. They're separated by 12 months of becoming someone who thinks differently. And that compounding, the compounding of identity and clarity, is actually harder to catch up on than the financial kind. You already have the information. The only thing left is the decision. You just covered more ground in 8 minutes than most people do in years of randomly Googling personal finance. And that's exactly what this channel is built for. If you're not subscribed yet, do that now. Every video here is the same deal. Real frameworks, real numbers, no generic advice you've already heard 100 times. Built specifically for people our age who are done waiting to figure this stuff out. And if you want to keep going right now, I broke down exactly how to pick your first index fund in the next video. No jargon, no confusion, just the actual decision-making process. Clean and simple. That's your logical next step from everything we just covered. Before you go though, drop a comment and tell me honestly, are you currently in the saving stage or have you already taken your first step into investing? I genuinely want to know where you're at because that shapes everything I cover next. I'm Jason. Go make a move. I'll see you in the next one.